Hello. Today we're going to talk about bonds and bonds listed or issued at a discount and how those are recorded and how we calculate the interest expense on a bond that has been issued at a discount. Okay, this company issues $600,000 worth of 7% bonds due in 10 years. Interest payable semi-annually. That's very typical. Most bonds pay interest every 6 months or semi-annually, June 30th, December 31st of each year. Now, assuming the market interest rate is 8%, which is higher than what the bond is paying, the bonds issue at 559 to 29. Now, you don't have to calculate that. These things are always given in your problems. But it's important that you understand that if the stated rate of 7%, what the company is going to pay the investor, is less than what the market rate or the going rate for similar investments is, then the investor is not going to be willing to pay full price for it because they are getting less in interest than they would in another investment. So that's why the bonds sell at a discount. Okay, the first entry is going to be to record the bonds. Okay, so they're selling the bonds for $559,229. That's the cash that the company receives. Bonds payable is the face amount of the bond, $600,000. That's what the company is going to pay the investors at the end of the bond period, which in this case is 10 years. The difference between the bond face value and what they are issued for, in this case, is a discount. If the interest rates were opposite, if the bond was paying a higher rate than the going rate, then the bond would be issued at a premium because the investor would be willing to pay more for the investment because they're getting a higher interest rate. All right, so that's the first entry. Now, we've got an amortization schedule here. Starts with the carrying value of the bonds. Okay, the carrying value of the bonds is the $559,229 that they were issued for. Each time we have an interest payment, we are going to amortize some of the discount so that when we get to the end of the 10 years, the payment amount of the face value is all we'll have left. Okay? Now, this is not as complicated as it looks. Cash paid for the interest is always going to be the same. It's always going to be the face amount of the bond times the interest rate half of the year. Okay, so in this case, our interest that is paid to the investors is $21,000 every 6 months for 10 years. Okay, column 3 of the schedule, we calculate the carrying value of the bond right here times the market rate and divide by 2. Okay, in this case, the market rate is higher, so our interest expense is going to be higher, and the difference is going to increase the carrying value or decrease the discount. Okay, now these discount on bonds payable or premium on bonds payable is a contra account attached to the bonds payable, similar to the allowance for bad debts attached to accounts receivable. So they're shown at the net amount. Okay, so the interest paid on June 30th, shown in the interest or in the journal entry, okay, $22,369. That's the interest expense. But the cash that was paid was $21,000. The difference is going to go to the discount on the premium. Okay, discount on the premium is a debit balance account. Okay, if it's a premium on the bonds, it's going to be a credit balance account. So here we've got the debit balance of the $40,771 that we started with. The $1,369 is the difference in the interest expense on June 30th. That's going to be a credit to the discount account, and we're going to get a new carrying value, which is going to be the original carrying value plus the increase for the amortization of the discount. Then we just go on to the next one. Okay, again, interest is always going to be paid on the face value at the stated rate. Interest expense is going to be different. It's going to be the carrying value times the market rate. Okay, and that gets us $22,424. Difference there is $1,424. Okay, and I'll scroll so you can see that entry. Okay, so interest expense is the $22,424. Increase in carrying value goes to the discount on bonds payable account. And again, the cash going out is always the same. It's always the face amount times the stated rate. Okay? Because a bond is a contract between the company and the investor, and that's what they're obligated to pay. Thank you.